Managers must know the different costs in today's business world to make informed decisions. Costs can have a significant impact on a company's profitability. In this article, we will discuss the 8 different types of cost in cost accounting. What is cost accounting? Cost accounting is keeping track of all the costs of producing a product or service. It's essential tracking your expenses to ensure you're making money. Cost accounting also helps you determine how much it costs to produce a product, which is useful when deciding how much to charge. If you know how much your raw materials cost and what kind of labor goes into manufacturing your product, you'll be able to figure out how much profit you will make from each item sold and then decide if it's worth producing the item in the first place. In addition to tracking expenses and profits, cost accounting also involves forecasting future costs and profits based on past trends. This helps businesses predict their future cash flow, which is vital for staying in business. 8 types of cost in cost accounting. Cost accounting is an essential part of business, and it's essential to understand the different types of costs you may encounter. 1. Direct cost types of costs. Direct costs are costs that can be directly attributed to the production of a product. Direct costs are usually variable, meaning they change based on the amount of production. For example, if you have a factory that makes shoes, then the cost of producing each pair of shoes is directly attributable to that shoe and is, therefore, a direct cost. Direct costs also include labor, material, and overhead expenses. Direct labor is paid by workers who work directly on making the product. Material costs are associated with buying components used in making the product. Finally, overhead expenses don't directly relate to making one particular product, but help keep your business running smoothly. For example, if your factory uses a lot of electricity to run, then that electricity cost would be considered an overhead expense. 2. Indirect cost types of costs. When you're running a business, you must keep track of all your costs. But nowadays, it's not enough to know how much it costs to make your product. You need to be able to understand the indirect costs that go into making sure your business is booming. An indirect cost is a cost that's related to the production process, but doesn't directly impact it, like electricity or cleaning supplies. These are indirect costs because they're not direct expenses, but more like costs supporting other costs. For example, if you own an ice cream shop and use electricity to power your refrigerators, electricity is an indirect cost of making ice cream. You couldn't sell any ice cream without a refrigerated storage area. Still, you pay for electricity separately from buying milk or sugar to make the ice cream itself. 3. Opportunity cost types of costs. Opportunity costs are the cost of lost opportunities. They represent the value of what is given up to gain something else. All businesses have opportunity costs, whether they realize it or not. For example, if you have a business selling ice cream and invest in an advertising campaign to attract new customers, you have just made an opportunity cost decision. You will now have less money available for other uses. You could have spent that money on any other things, like new equipment for your factory or paying off debt, but instead, you chose to spend it on advertising. Another example of an opportunity cost is when a company stops production temporarily because it cannot afford to hire more workers or buy more machines to increase production levels. In this case, the company loses out on increased revenue from selling more goods. However, it also avoids incurring additional expenses such as employee benefits and taxes owed to government agencies due to higher wages paid during times of high demand for labor. Another example is choosing not to go to college because you want to be an entrepreneur. In this case, going to college would be the opportunity cost since it would offer more job security, but being an entrepreneur offers more freedom. The concept of opportunity costs can also be applied to personal decisions, such as choosing to spend time playing video games instead of doing homework. The opportunity cost of your decision would be the potential grade you might have earned if you did not play video games. 4. Some cost types of costs. Some costs are a type of cost you cannot recover and should not be considered when making decisions. In accounting terms, some costs are often referred to as historical costs. They are costs already incurred, and there is no way to return them. You should factor them into your decision-making process because they do not help you make better decisions in the future. For example, if you decide to buy a new car, the cost of the car is sunk cost. Once you've purchased it, you can't get your money back, you're stuck with it. For another example, imagine you're considering going on vacation with your friends. The trip costs $1,000 per person, but it's paid for in advance and non-refundable. You can't get that money back if you decide not to vacation with them. In this case, the cost of the trip is a sunk cost. It's been paid for and cannot be recovered. Also, if you buy a new house, the cost is sunk. The same goes for any other non-refundable purchases you've made. If you discover that you don't like what you bought, it's too late to get your money back. So even though some costs are actual and concrete, they're relevant when deciding whether to continue spending money on something. Some costs are also called sunk expenses or recoverable costs. They differ from variable expenses because you can change variable costs based on how much you spend on them. The total cost will increase if you spend more money on variable expenses, but spending more money on some costs doesn't matter because the total cost will still be fixed. You can't increase it by spending more money. Buy fixed cost types of costs. Fixed costs are expenses that do not change with fluctuations in production. They are also known as overhead costs because they are overhead to the organization. Fixed costs include rent. Rent is the money you pay to lease office space or a building to house your business. It does not change when you produce more or less of your product, but remains consistent throughout the year. Salaries. Salaries are the salaries paid to employees who work for you regardless of how much work they do or where it is done. Salaries can include payroll taxes, insurance premiums, and company benefits, such as health care coverage or retirement plans. These costs do not change with fluctuations in production either. They are considered fixed because the amount of money set aside for them remains constant regardless of how much product is produced during any given time. Insurance. Insurance is a type of protection against potential losses. It does not change with production levels, but is paid out if something wrong happens to your business, like a fire or theft. Interest on loans. Interest on loans is the amount you pay to borrow from a lender. The interest rate remains the same even if you produce more or fewer products, so it is a fixed cost. 6 operating cost types of costs. Operating costs are associated with a business's day-to-day operations, like utilities, equipment maintenance and repair, employee salaries, and more. Operating costs are necessary to keep a business running, but aren't directly tied to creating products or services. As an example of operating costs, let's say you own a restaurant that sells hamburgers for $10 each. Your labor costs would be your employees' salaries, including taxes and benefits, would be your labor costs. The cost of ingredients would be another operating cost. You might also have some utility bills, perhaps it's higher when you're making lots of food. Suppose your business is in a retail space and you're selling products rather than offering services. In that case, some operating costs could still be associated with your store that wouldn't tie into making or selling those products. 7 controllable cost types of costs. Controllable costs are expenses that a company can change. It is the cost that a business can control directly. For example, if your company has employees. In that case, their salaries are an example of a controllable cost. You can choose to pay them more or less, which will change how much that part of your budget affects your total expenses. These expenses are sometimes referred to as direct costs because the company can control them directly. The opposite is fixed costs, expenses that the company cannot control, therefore cannot be changed. Controllable costs include equipment maintenance, employee salaries and bonuses, sales commissions, and advertising. 8 variable cost types of costs. Variable costs vary with the number of goods produced or sold. For example, if you're running a taco stand and buying tomatoes for your tacos, the price you pay for each tomato will change based on how many tomatoes you buy. Another example is if you're making a batch of peanut butter cookies and must buy a certain amount of flour and sugar. Those are variable costs because they change depending on how many cookies you make. If you make more cookies, you'll use more flour and sugar. Variable costs are also called direct costs because they are directly associated with producing goods or services. They can also be called premium costs because they are directly related to production. The variable part of variable cost refers to the fact that these costs can change depending on how much output is produced. For example, if you own a small business that manufactures custom mugs, your variable cost per mug will increase as you produce more mugs. Types of cost accounting methods. Cost accounting is accounting for the costs associated with producing goods or services. It's important to understand that different cost accounting methods fall into 4 main categories. Standard cost accounting types of costs. Standard cost accounting is one of the types of cost accounting. It compares actual and budgeted costs to determine whether the company is making a profit. Standard cost accounting uses standard cost as a baseline, the average cost associated with producing a particular good or service. This method helps companies understand how much they should spend on an item based on its production costs, and then compare their actual spending against that standard to ensure they stay within budget. The most significant benefit of standard cost accounting is that it allows businesses to compare their actual expenses with what they expect based on their budget. This gives them a clear picture of whether or not they're making money from each product or service they offer, and if not, where those losses are coming from so that they can adjust accordingly. The drawback of this type of accounting is that it requires a lot of time and effort on behalf of managers, who must create these standards themselves and then keep track of them over time. Companies may need additional resources for this method to work effectively for them. Standard cost accounting should be used when you know how much it costs to produce your product or service. It can help you identify areas where you waste money due to inefficient processes or inaccurate measurements. For example, suppose you know that a specific part of your manufacturing process takes too long and uses too many resources. In that case, Standard cost accounting will alert you when something goes wrong so you can make changes before more severe problems arise. Activity-based costing types of costs. Activity-based costing assigns costs to products and services, allowing for more accurate pricing, increased control over costs, and greater company activity transparency. The main benefit of this method is that it allows companies to understand better the actual cost of each activity they perform, which in turn helps them make more informed decisions about reducing costs and improving performance. It also provides better visibility into overhead expenses so managers can decide where to focus. It can help identify opportunities for improvement, and it improves communication between departments by providing insight into how much work is done in each area. In addition to helping companies make better decisions, activity-based costing has drawbacks. For instance, implementing it can be difficult and time-consuming because it requires extensive data analysis and statistical modeling. Also, this type of costing does not consider fixed costs like depreciation or overhead expenses, which can skew results if they are not considered when calculating total costs for each company's product or service. Activity-based costing should only be used when all relevant information regarding activity costs associated with each company's product or service has been collected from all departments involved in providing those products or services. Job costing types of costs. Job costing is a form of cost accounting used to track individual jobs costs. It allows businesses to compare their actual and planned costs and helps companies determine whether they meet their goals. Job costing is beneficial because it can help companies determine whether they need to change their business processes to meet their goals. For example, if you have more overhead costs than expected, you may want to look at your business processes and see where there are opportunities for improvement. For example, you might consider outsourcing some parts of your production process or changing how you manage expenses or staff. However, job costing does have some drawbacks as well. For example, it requires the company's employees performing the work on each job to record all their time spent working on that job and then calculate how much each activity took from them. This can be challenging for companies whose employees work remotely or don't use standard timekeeping systems like a clock in, out at work every day. When should you use job costing? You should use job costing when you need accurate cost information to decide whether you should pursue a particular course of action. For example, job costing is a helpful tool for a company when deciding whether or not to produce its products instead of buying them from another company. It's important to note that job costing is not used as often as traditional cost accounting types like process and standard costing because it requires more effort and time to set up. However, it can be beneficial if you work in an industry with many small projects or have multiple customers who order products in small batches or at different times throughout the year. Process costing types of costs. Process costing is a type of cost accounting that breaks down the cost of producing a product into the individual steps it takes to make that product. It's often used in manufacturing, where a product can be broken down into many small parts, each tracked separately. This makes tracking and managing costs easier, especially when you want to see how much each part contributes to overall costs. Process costing is typically used when a company has high fixed and low variable costs, which means they need to keep their employees around even if they don't sell much product. For example, if you're making cars in America and selling them overseas, you might want to know exactly how much labor goes into each car so you can price them accordingly. Process costing has some benefits. It makes it easier for companies with high fixed costs and low variable costs to see what effect changing prices have on their bottom line. It helps employees understand where their efforts are contributing most significantly. It allows companies to take advantage of economies of scale. But there are also drawbacks. Process costing doesn't take into consideration external factors like competition or demand. Sometimes it's difficult or impossible to track all of the steps in a production process accurately. It can lead to managers only focusing on the costs of their department and not seeing the big picture. When should you use process costing? It would be best to use process costing when you have high fixed and low variable costs, and when you need to see how changing prices will affect your bottom line. This is often the case in manufacturing, where it can break products down into many small parts, tracking each step of the production process separately. What are the challenges of cost accounting? Cost accounting is the process of tracking and managing costs. Understanding it can be a little bit challenging, but it's critical to running a successful business. The first challenge of cost accounting is that learning all the different methods and techniques used to track and manage costs takes time. You'll have to learn about things like direct materials, indirect labor, overhead costs, and other related topics before fully understanding how each one works in practice. The second challenge is that it can be difficult to determine whether or not you're using the proper method or technique for your particular situation. For example, suppose you're manufacturing something in-house. In that case, direct materials might be easier than indirect labor because they'll all happen within one place without involving transportation costs. However, it might make sense to use indirect labor if you're buying from suppliers. Those costs will already be incurred before anything is shipped out. There won't be any additional paperwork required, as you already did it during other ordering, purchasing processes. The third challenge is those cost accounting methods, and techniques can change over time as new technology emerges or the business landscape changes. For example, if a new piece of software streamlines the process of tracking and managing costs, you'll need to learn how to use it to keep up with the latest and most excellent methods. The last challenge is finding accurate and up-to-date cost information can be complex. This is especially true if you're trying to track indirect labor, which could involve many different people in different departments working on different tasks. It can be hard to get an accurate picture of those costs without spending much time tracking down the correct information. Cost accounting. Why cost accounting is necessary. Cost types frequently asked questions. Why is it important for cost accountants to understand all cost types? Cost accountants provide key financial information to the organization by tracking, measuring, and analyzing costs. As such, they need to have an understanding of all cost types. This includes fixed costs, variable costs, direct costs, indirect costs, overhead costs, and capital expenditures. Fixed costs remain constant regardless of changes in production or sales volume. These include rent payments and insurance premiums. Variable costs vary with production or sales volume. Examples of variable expenses include materials and supplies used in production and direct labor wages paid to employees. Direct costs can be easily tracked back to a particular product or service. In contrast, indirect costs cannot be directly linked to a specific product or service but are necessary for the daily operation of a business. Examples of indirect costs include administrative salaries, marketing and advertising expenses, utilities, and property taxes. Overhead costs are associated with running a business but are not tied directly to production or sales activities. These include rent payments, insurance premiums, depreciation of buildings and equipment, legal fees, and accounting services. Capital expenditures refer to significant investments in long-term assets such as land, buildings, machinery, and vehicles. By understanding all cost types and their impact on the organization's financials, cost accountants can help managers make informed decisions about how best to use resources. They provide critical information that organizations need to optimize operations while remaining competitive in the marketplace. The ability to accurately measure, track, and analyze all cost types is an essential skill for cost accountants. Cost accounting is a complex field that requires close attention to detail. Understanding all cost types helps ensure accurate financial reporting and can help organizations achieve their strategic objectives. Cost accountants are crucial in helping businesses make sound decisions about using resources effectively and efficiently. Without this knowledge, assessing the actual costs associated with running the business or investing in long-term assets would not be easy. The key takeaway is that cost accountants must understand all cost types to provide the best possible information for decision makers within the organization. What happens to product costing accuracy if a cost type is misclassified? If a cost type is misclassified, it could lead to inaccurate product costing and pricing. For example, if an overhead cost such as advertising is classified as a direct cost, the total cost of producing the products will be overstated. This could result in incorrect pricing decisions and reduce profitability for the business. On the other hand, if an expense that should be categorized as direct costing is instead classified as overhead expenses, it will understate the actual costs associated with production and cause poor budgeting decisions. Inaccurate product costing and pricing caused by misclassifying costs have serious implications for businesses since their bottom line depends on accurate accounting calculations. Therefore, ensuring all costs are appropriately allocated when determining product prices is crucial. In conclusion, this classification of cost types can lead to inaccurate product costing and pricing, which could have a detrimental effect on the financial performance of a business. Therefore, all costs must be classified appropriately to ensure accurate and optimal product pricing. This will help businesses maximize their profits and make informed decisions about their production costs. What to do if you are unsure of the cost type? How do you clarify? If you are unsure about the cost type of an item, there are a few steps you can take to clarify. First, discuss with the supplier and ask them to provide any additional information they may have that can help identify the cost type. If possible, also request invoices or other documents that validate their claims. Additionally, it helps similar research items that have already been purchased and uses them as a guide. Finally, if you still have questions after gathering all this information, contact your company's finance department or external accounting service for expert advice on classifying costs correctly. They will be able to guide you in making an informed decision and ensure proper compliance with financial regulations. These steps will clarify cost types and help you make the best decision for your company. Can cost types change over time? Yes, the types of costs associated with a project can change over time. This can be due to several reasons, including changes in the scope of work, changes in technology or materials used, or shifts in market conditions that cause labor and other costs to rise or fall. Any project manager needs to keep track of these changing costs to make informed decisions about how their budget should be allocated. By staying current on potential cost variations, they can ensure their projects stay within budget while still providing quality results. Additionally, it helps them plan for future projects by considering how different factors may affect costs. Knowing this information upfront allows them to accurately predict what resources must be allocated and where costs may be saved. Awareness of the potential for cost changes over time can help any project manager stay in control and ensure successful outcomes. What is the most challenging cost for manufacturers to manage? One of the most challenging costs for manufacturers to manage is labor costs. This cost can vary from business to business, depending on the type and amount of products they produce, but it greatly impacts their bottom line. As labor costs continue to rise, manufacturers must find ways to reduce them without sacrificing quality or efficiency. This includes assessing current staffing levels, streamlining processes, and reducing waste wherever possible. Additionally, investing in automation technologies and leveraging data analytics can help companies better understand their labor costs and make informed decisions about managing them more effectively. By managing labor costs carefully, manufacturers can ensure that they remain competitive while still delivering high-quality products at affordable prices. What are understanding cost types so challenging? Understanding cost types can be challenging due to their complexity and the many variables involved. Cost types involve multiple components, such as labor cost, materials cost, overhead cost, and other expense-related items. Additionally, some cost types may vary based on a company's size or industry. These factors make it difficult for business owners to accurately determine the most applicable cost in any given situation and how much money should be allocated to each cost type. Furthermore, manual data entry into accounting systems can lead to errors that are difficult to anticipate or identify until after the fact. Understanding all applicable cost types is essential for successful financial management and decision making. Moreover, businesses must ensure they have the right accounting processes to accurately track and analyze cost-related data. This includes creating accurate budget forecasts, cost estimates, and cash flow projections for various purposes. With the proper procedures and tools in place, business owners will be able to gain a better understanding of their current costs and plan for future expenses. How does having a highly skilled cost accounting team help ensure your costs are categorized and analyzed correctly? A highly skilled cost accounting team ensures that all costs are correctly categorized and analyzed. This team can ensure that the correct data is used to make informed decisions on expenses, so there is no wastage of resources or unnecessary spending. A cost accountant will also analyze current trends in pricing and production, allowing for accurate budgeting and forecasting of future costs. By ensuring your costs are accurately tracked and measured, you can be confident that your business is running at peak efficiency with minimal waste. A reasonable cost accountant can also help identify areas where expenses may be reduced or made more efficient without sacrificing quality or customer service. They can assist in finding ways to cut costs while maximizing profits. Moreover, having a well-managed cost accounting system allows for better decision-making on prices and investments. This helps ensure that the business operates financially stable with maximum efficiency. In conclusion, having a highly skilled cost accounting team is essential for businesses to ensure their costs are correctly categorized and analyzed. This team can help track expenses and provide accurate data for management decisions, so the business runs efficiently while minimizing waste. Cost accountants also help identify areas of potential cost savings while increasing profits, allowing businesses to operate more effectively. By utilizing the services of an experienced cost accountant, businesses can be confident that their financials are accurately managed with minimal wastage of resources or unnecessary spending. What should you do if your company has misclassified cost types? If your company has misclassified cost types, it is vital to take action quickly. The first step is to identify the misclassification and review all related documents and contracts. Once you have identified the error, notify everyone involved in the transaction and adjust any financial statements or documents accordingly. Depending on the misclassification type, more steps may be needed to rectify the situation. For example, suppose taxes were not paid adequately due to incorrect expenses or revenue streams classification. In that case, you must set up a payment plan with your local tax authority immediately. You should consult a qualified lawyer to address any potential legal issues associated with the misclassification. Finally, it is crucial to take steps to ensure that the misclassification does not happen again in the future. Establishing a system for double-checking any financial classification decisions and implementing internal controls to verify all transactions are two ways to prevent further errors. These proactive measures will help minimize the potential risks associated with misclassified costs in the future. It's crucial to address cost misclassifications quickly, as they can have financial and legal repercussions. By taking swift action and putting processes in place to avoid similar mistakes, you can help protect your organization from unnecessary complications. How do cost types affect product costing and profitability analysis? Cost types can have a significant impact on the profitability analysis of products. Knowing the different cost types and their effects can help to ensure that product costs are accurately calculated and that an accurate picture of profitability is obtained. There are three main cost types: direct, indirect, and overhead. Direct costs are those associated directly with producing a particular product or service, such as material and labor. Indirect costs are expenses unrelated to production, but still necessary for running a business, such as utilities and administrative salaries. Overhead costs represent ongoing operating expenses such as rent, insurance premiums, taxes, and depreciation charges. Direct costs are typically the easiest to measure since they can be traced directly to individual product or services. This makes them ideal for analyzing the cost of producing and distributing a particular product. Indirect costs, however, are difficult to trace to individual products, as these expenses are incurred throughout the entire business. Overhead costs can also be hard to attribute accurately since they may not vary much over time or between different products. Accurately determining the cost types associated with a product is paramount in conducting an accurate profitability analysis. Companies must understand the difference between direct, indirect, and overhead costs to determine the most effective way of achieving more significant profits. Knowing which costs should be included in each type helps managers make informed decisions about pricing strategies, production methods, and other operational issues that affect profitability. Overall, any business must understand the cost types associated with its products to conduct an accurate profitability analysis. Knowing how each type affects product costing and pricing can help managers make informed decisions that will ultimately increase profits. Do FP and its systems help analyze and track product cost types? Cost types can have a significant impact on the profitability analysis of products. Knowing the different cost types and their effects can help to ensure that production costs are accurately calculated and that an accurate picture of profitability is obtained. There are three main cost types: direct, indirect, and overhead. Direct costs are those associated directly with producing a particular product or service, such as material and labor. Indirect costs are expenses unrelated to production, but still necessary for running a business, such as utilities and administrative salaries. Overhead costs, such as rent, represent the overall business expenses. Financial planning and analysis systems can help analyze and track these cost types and their impact on profitability. For example, FP and its systems provide visibility into which products generate higher profits and which costs drive them up or down. This information can be used to identify cost savings opportunities and to ensure that prices are set correctly to maximize profit margins. Additionally, these systems provide the ability to monitor performance over time, giving users insight into how pricing strategies have changed over time and their effect on profitability. In conclusion, FP and its systems can help organizations better understand product costs and their associated effects on profitability analysis of ongoing operating expenses such as rent, insurance premiums, taxes, and depreciation charges. Direct costs are typically the easiest to measure since they can be traced directly to individual product or services. This makes them ideal for analyzing the cost of producing and distributing a particular product. Indirect costs, however, are difficult to trace to individual products, as these expenses are incurred throughout the entire business. Overhead costs can also be hard to attribute accurately since they may not vary much over time or between different products. Accurately determining the cost types associated with a product is paramount in conducting an accurate profitability analysis. Companies must understand the difference between direct, indirect, and overhead costs to determine the most effective way of achieving more significant profits. Knowing which costs should be included in each type helps managers make informed decisions about pricing strategies, production methods, and other operational issues that affect profitability. Overall, any business must understand the cost types associated with its products to conduct an accurate profitability analysis. Knowing how each type affects product costing and pricing can help managers make informed decisions that will ultimately increase profits. Through FP and its systems, companies can analyze and track cost types and better understand their impact on profitability. This helps them to identify cost savings opportunities and optimize pricing strategies for maximum profit margins. 8 types of cost in cost accounting. Conclusion. In conclusion, the 8 types of cost in cost accounting are direct cost, indirect cost, opportunity cost, sunk cost, fixed cost, operating cost, controllable costs, and variable costs. All these costs are important in cost accounting, and each cost type has unique characteristics. As a business owner or manager, it is crucial to understand these costs to make informed decisions about where to allocate your resources.